Are you an accredited investor and looking to deploy capital into one of the strongest asset classes on the planet? If you said yes, I want to invite you to join me for a free webinar this week to show you some of the opportunities Blue Spruce has been focusing on. That link is in today's show notes. Enjoy today's episode.
It's time for the Creative Real Estate Podcast, your source for out-of-the-box real estate investing strategies, brought to you by realbluespruce.com.
Welcome back to the Creative Real Estate Podcast. I'm your host, Adam Adams, and today we've got a great episode. We're going to talk about the exact 5 ways that you make money with multifamily investing. Before we get started, I am going to share a listener's 5-star rating, and it says, wealth of knowledge. I'm so impressed of the guests that have been on this show, and I recommend to everyone that is investing to check out these podcasts and see how you can add any kind of tidbits to your own business. For people just starting out and interested, this will help you think outside the box and how many ways there are to get your foot in the door to start investing. Thank you for that 5-star rating. And if you want to have one of our gifts, just take a screenshot of your rating and email it to me at adam@realbluespruce.com, and I will go ahead and get you a fancy gift, a Happiness is Passive Cash Flow mug, Happiness is Passive Cash Flow shirt, or the book that's about to come out on how you can make the best meetup in your area. All right, so today we are talking about the 5 ways you make money in multifamily. The first one is by cash flow, okay? This one is the one that I think is the most important. Some other people think the 5th one is the most important. And, you know, to them, it probably is. So when we get to the 5th one, that's the one that all those doctors, lawyers, and attorneys need the most, okay? So I can't wait to discuss the 5th one, but let's talk about cash flow. All right, so the best way to get out of the rat race, guys, is to replace your income. All right. So right now I own several buildings, well over 100 doors of multifamily. Okay. And I bet if I buy with my team probably 1 or 2 more buildings, then that passive, just the passive income, not let alone anything else that's coming in, right? Just the passive monthly income will be taking care of all of my expenses, okay? So I just need to buy 1 or 2 more buildings, and I'll be, in essence, completely retired. If I were you, I would focus all my efforts on cash flow. All the fix and flippers are out there. You're not going to get out of the rat race by turning houses upside down. That's kind of a joke. I hope somebody laughed. Okay, so the flippers out there, that's not the way to retire. Sure, you'll make a chunk of money, but the best way to get out of the rat race, the best way for wealth, the best way to get to your end goal and never have to work again is cash flow. All right, so that's number 1. Number 2, principal pay down. So this is fantastic. And as you know, even if you have single family residences, you'll be able to have your tenants pay down the principal. So this is a wonderful, wonderful thing. And the best part about the principal pay down, when you have a huge apartment building, okay, millions and millions of dollars where hundreds of thousands are coming in. Let's just say on my last 83 unit, okay, the 83 unit, I believe that our net operating income is well over 300,000, okay, 300K net operating income. And about 150 of that or so goes to the mortgage, okay? 150,000 of the money that all of my tenants are paying me, 150,000 every year, is going to principal pay down. That's money that I'm making. That's money that I'm noticing, that I'm seeing, but I don't have to pay a dime of it. I don't have to work hard for it. And if I let that mortgage go 30 years, that's an extra $150,000 per year just on a small 83 unit. So you can see how this can scale, right? So principal pay down, number 2, one of the best ways that you're making money on your multifamily. This 3rd one is forced appreciation, okay? This isn't something that you find with every single family out there. You don't always see forced appreciation. because it's harder, okay? But when you have a multifamily, all you have to do is don't raise expenses. Okay, you raise the income and you lower the expenses. That way you're changing the NOI. NOI means net operating income. Net operating income is the amount that you're netting, except for the mortgage, after all of your income minus all of your expenses, except for the mortgage. That's your NOI. And you just change that NOI a little bit. And based on the cap rate, you can force appreciation. For every $1-ish you change per month, it's about $100 that you change for the property. That means if you raise rents are by just 100 doors by $100 a door, and I believe that's about 10,000, and that you multiply that by the per year is about 120,000. Again, this is only $10 a month. $100 a month per unit. And it ends up being 120,000 that you're raising by the end of the year. But if you divide that just by, let's just say a 7 cap, then the extra amount that you've done, let me see, 120. I'm doing this on my calculator, guys, so that I can be held accountable. Divided by 0.07, 120K divided by 0.07 is $1.7 million. Does that make sense? You raise all rents by just $100. Your whole value of the property based on a cap rate of 7 is $1.7 million extra. Not just a new 100, not that it's just worth 1.7, it's worth 1.7 more than it was the day before you raised rents $100 per door for 100 doors, 10K a month, 120K per year, divided by a 7 cap is 1.7 million. Forced appreciation, fantastic, amazing. This is one of the main reasons why people are making so much wealth. They're able to be into these properties and then out of these properties in 3 to 8 years, and they're making $1 or $2 or $3 million just on the medium-sized assets, the 100-door assets. Imagine how that scales when you go up to 200 doors, all right? So these are the first 3, and we've got a quick word from our sponsor, and we'll be right back in with the last 2.
I'm Rod Cleef, and I'm host of the Lifetime Cash Flow Through Real Estate Investing podcast. Now, we've been blessed to be the #1 real estate podcast on iTunes for almost 2 years straight, with over 3.5 million downloads. Now, I'm also an apartment investor, and I've owned over 2,000 homes and apartments so far in my career. Now, on August 24th through the 26th, I'm going to be hosting a 3-day multifamily boot camp in Chicago. And I've asked Adam Adams to be an expert on a panel there with some other members of our multifamily mastermind group. Now, if you're like me and you realize you learn so much better in full immersion at a live event with no distractions, and you actually want to do your next apartment deal within the next 90 days or so, you need to text multifamily to 41411 or go to multifamilybootcamp.com right now. Take massive action, because this event's definitely going to sell out. We've got fantastic early bird pricing right now. So don't wait. Go to multifamilybootcamp.com or text the word multifamily to 41411. And Adam and I look forward to seeing you in person in Chicago, August 24th through the 26th.
Okay, we are back. The last 2 out of the 5 ways you're making money in multifamily is natural appreciation. We talked about cash flow, principal pay down, forced appreciation. This is where you actually have control over the value of your property. Now, number 4 is the natural appreciation. Over time, real estate gets more and more expensive. Over time, rents get higher and higher and higher. Apartment buildings tend to keep up with inflation. I don't know what inflation is, but it is a word that I made up. It's kind of like appreciation and inflation. Anyway, the natural appreciation is by rents going up. Based on that cap rate, you slowly are making a lot more value. Again, real estate gets more and more expensive. Everyone knows they're not making any more of it. So the natural appreciation is a fantastic way to wealth through apartment investing. And the 5th one, where the doctors, the lawyers, the attorneys, anybody, the huge sales guys that are making hundreds of thousands or even millions of dollars a year have a horrible problem, and that is that they're paying a ton of money in taxes. Nobody wants to pay more in taxes than they have to. And one of the best ways not to pay taxes is by depreciating your assets. All right. So I don't want to get too far into the weeds because I'm literally not a CPA. So it doesn't matter anyway. But why don't you talk to your CPA and find out if you're making too much money? You just go and find out, how am I able to put some of this money into an apartment syndication and be able to capture depreciation through something called a K1, which is, let me just give you a quick example. All right. Let's say you were in that last 83 unit of Blue Spruces. If you were in my last 83 unit and you paid about $100K into the deal, and what that would allow you to do is you'd probably make, again, I'm not making promises, so any type of investment, like I'm not telling you exactly how much you're going to make in any of my deals, right? I'm just saying on that last one, if you made, please quote me, if you made about 10K of cash flow that year, about 10% return or whatever, let's just say that's the number, and you put in 100K, that's 10%, that's 10K. Guess what the biggest goal of my company and any, hopefully, other syndicators, I can't really speak for them, but the goal is to be able to pass through some depreciation. So wouldn't it be nice if you put 100K into somebody's deal and you made 10K that year? You made positive 10K of passive cash flow, but you got a K1 and the company focused on something called accelerated depreciation through a method called cost segregation, whereby you take little things in that property, okay? Like let's just say some doorknobs, maybe the roof, maybe the gutters, maybe some of the lights, and you, instead of depreciate that asset over 27 and a half years or 39 if it's just a regular commercial, by 27 and a half years as a multifamily, every year you do a 27th of the value of the property. Not the value of the land, but yes, the land improvements, okay? And all of a sudden you have the opportunity to write off, because you're accelerating the depreciation. Some of those items can be accelerated over 5 years, some I think 7, some I think 10. Talk to your own cost segregation expert, get them to come, but the goal is that we allow you to actually show, don't be scared of this because this is a good thing, show a negative. That's the goal. You made 10K positive in your pocket, but because of depreciation and utilizing these strategies, hopefully you either show maybe a profit of 1,000, or you show a profit of 0, or you show a profit of negative. And that's the goal. And you can do this with or without syndications. Maybe you just want to go and buy your own apartment building. I want you to feel comfortable to do that. If you feel confident in managing the asset or managing the manager, please, please, please go and focus on your depreciation. Talk to your best CPA on how you can do this. And if you need any recommendations, just email me at adam@realbluespruce.com. I'll put you in touch with the right people. Not the ones that are paying me. None of these guys are giving me a dime for recommending them. I just know some really good people, and I want you to have the best resources out there, and I want them to be able to help you, okay? So I'm happy to do that. For any of you listeners, if you want some recommendations on depreciation, cost segregation, or CPAs out there who are able to just give you the right information and help you move forward in your real estate investing goals. Thank you for being with me. And until next time, my friends, think outside the box.
Right now, many people are unhappy with the returns they're getting from the stock market. Blue Spruce Holdings is currently showing investors how they can get higher returns secured by one of the safest asset classes on the planet. Sign up for our free webinar we are having this week by following the link in today's show notes.